So welcome back to Bunnex Investment Group. In this video, we are going to talk about a recession-proof strategy. So we are all aware that next year there is a high probability that the economy is going to face a huge recession. So if you don't understand what that is, feel free to actually research more about what recessions are and how they actually affect the financial markets. So this particular strategy is going to be one, robust, simple, and easy to execute. No need to actually complicate a lot of stuff, and let it be your edge within that trading environment that we are facing. So we are basically going to be trading trend trades. And for those who follow us for quite a while knows that we are actually in a process of recruiting traders who will trade with for the upcoming year with funded accounts. So this is going to be one of the strategies that we'll be using. It's going to be a trend trade. Unfortunately, we are not going to be revealing all the steps that are required in order for you to make some entries, but to at least have an edge within the markets. So basically, we call these type of trades ID 50s or intraday 50s or 50-50 bounces, no matter how what you want to call them. So it requires several indicators. As you can see, there are several EMAs on my chart, and these EMAs are actually used in depth from our methodology. So this is just one part, but this part will definitely help you if you follow through and watch throughout the video. So make sure you hit that subscribe button if you haven't done so, and check the notification bell icon. So firstly, I'm going to define my my parameters that are important to me. So we have a turning point that is called a peak. A peak is where the market actually reverse or makes a turning point. So this is a peak, and how can we identify that peak? So our first step is to actually learn how to identify peaks in a very simpler way. So basically, a peak is a point that is very difficult to trade from, because it's basically calling a reversals on a falling knife, or actually predicting the market that it's going to reverse here. In other words, we are saying a trading peaks is actually trading a counter trade, right? The market is going up, and then you say at this point we are going to make a reversal. So it's basically trading a counter trade. So in this case, we actually see that the market made a turn at this point. And how were we going to know that this is a high probability turn and we now have a new trend that is now forming? We can only do so by counting of levels. And as I always say, levels are impulsive rises or drops that are issued by market makers on our charts due to the governance of external authorities within their operations. So from this point, we can start to see levels as days of drop. We had the first day of drop, then there was a consolidation up to this point, then another day of drop, and then the last day of drop. Therefore, marking these points, we are going to say we had this as a day of drop, and we had all this as consolidation. So from consolidation, we had the second level or the second impulsive drop to this point, and then the last impulsive drop was issued to this point. Therefore, after we reach three levels of drop or rise, we expect, or we term that point the peak point. However, as I have said, it's difficult because at the peak point, market makers are there to actually do several stuff to manipulate the prices. So from this zone, which is this one, that is where we call the peak. So after determining the peak using the levels criteria, we then now start to look for our entries. So our entries are going to be these points where we have the market reversal to the 50 EMA only after level 1 has been issued. So after seeing this point, our next thing was now to see a floor or level 1 floor like that. And then after level 1 floor, we need to see the market making a retracement to the blue EMA, which is the 50 EMA. Just a definition of all the EMAs available on my charts. We have the 5 in yellow, 13 in red, 50 in blue, 800 in dark blue, and 200 in white. So a pullback to the 50 EMA is where we will make our entry. From that point, we now start again to look for a new peak. But whenever we take these entries, always know that we have actually taken our bias from only one time frame. So make sure these are only intraday trades and you are out, because if you try to swing, you do not know what is actually taking place on the higher time frames. Then from there we can start again counting our levels. We had 1, 2, and from 2 we had a consolidation phase and we reached that third point, which is the third level, and we also term that point as a peak. We are not interested in trading that peak. Why? Because it's actually a counter. We need to see that the market is fully reversed, and if the market fully reverses, we now start to look for an entry. In this case, can we see a pullback to the 50? There was no pullback to the 50 because that pullback is only respected if we have a crossover of the 13 and 50 EMA. From there we can see day of drop, another day of drop. Therefore this was a valid peak, right? We've said the first step is to see a valid peak. Valid peak comes after 3 levels of drop or 3 levels of rise. From there we can now start to count again, but in this case we were now waiting for an entry which is a retest of the 50 after level 1 floor, and level 1 was issued at this point. It was a floor, and retest of the 50 was at this point. We had an entry. So just counting back, we can see that from the only point, from this small point that we have analyzed, we can see that we had one correct trade and another correct entry. By correct, we are not saying a winning entry. We are saying an entry that was following the parameters that we were talking about. That is the secret of trading. Many traders are looking for correct entries or are looking for winning entries instead of correct entries. If you have that perspective, you'd see that you can easily throw away your edge. So having another example on pound against dollar, we had 1, 2, 3. Therefore this was a peak. If a peak was issued, the next thing is to trade away from that peak and in line with the market trend. From there we can see there was an entry here. From that point we had 1, 2, 3. It was actually an ugly W. After 1, 2, 3 days of drop, we had its apex and then its second leg. From there we had the first retest of the 50 at this point, which was an entry, and from there we had 1, 2, 3, and after that, where was our first retest of the 50? It was at this point. At this point we required another criteria for actually taking this particular pattern. This pattern on the smaller time frame was actually an M pattern. Then from there we had 1, 2, 3, and this was a valid peak. A valid peak, trade away from that peak, and the crossover was issued after level. This was the first level, and retest of the 50 was issued. Then we had 1, 2, 3. This was a peak first after that. So these crossovers always okay, but as I am illustrating, only take them whenever a valid peak is issued. Do not just take them. A valid peak, as I've said, is 1, 2, 3. From that, a crossover, a retest of the 50. In some cases, the market won't give you as clear levels like that. You can see something like this, right? from these particular points. That is why I'm emphasizing to trade these trades away from valid picks that you have validated yourself. On that note, we come to the end of this video. Thank you for watching, and check out our free Telegram channel. I'll leave the link down in the description box below. See you on the next one.